The United States government owes $34 trillion, and Bitcoin is responding, not because Bitcoin cares about government debt, but because the only mathematical solutions to $34 trillion in debt all create conditions that make Bitcoin more valuable. Let me show you 3 documented facts that connect U.S. debt directly to Bitcoin's price mechanism. Fact 1, according to U.S. Treasury data published at treasurydirect.gov, federal debt crossed $34 trillion in January 2024, with annual interest payments approaching $1 trillion for the first time in history. Fact 2, according to Congressional Budget Office projections published in 2024, U.S. debt is projected to reach 166% of GDP by 2054 under current policy, with no mathematical path to reduction without either massive inflation or default. Fact 3, according to on-chain data from Glassnode covering 2020-2024, Bitcoin accumulation by long-term holders accelerates during periods when U.S. debt to GDP ratio increases most rapidly, showing correlation coefficients above 0.75. All verifiable, all documented in public data, all pointing to the same conclusion. The U.S. debt situation has only 3 possible endings. Ending 1, inflate the debt away, print money, devalue dollar. Ending 2, default or restructure, break promises to bondholders. Ending 3, perpetual growth forever, mathematical impossibility. Bitcoin benefits from ending 1. Bitcoin benefits massively from ending 2. Ending 3 doesn't exist, so Bitcoin benefits regardless. By the end of this video, you'll understand exactly how sovereign debt crises create the conditions Bitcoin was designed for, why this particular debt crisis is different from all previous ones, and what historical precedent tells us about Bitcoin's role during currency debasement. Because there's a 3-stage pattern to how sovereign debt crises unfold. Stage 1, debt accumulates to unsustainable levels, decades of buildup. Stage 2, interest costs force impossible fiscal choices, 5-10-year squeeze. Stage 3, currency debasement or default, crisis resolution through monetary destruction. The United States entered Stage 2 around 2022-2023. Based on historical precedent, Stage 3 begins when debt service exceeds 20 to 25% of government revenue. According to Treasury data, the U.S. is approaching 20%, which means Stage 3 could begin within 3 to 7 years. And Bitcoin, mathematically, must rise as Stage 3 approaches, not speculation, mathematics. Stick with me, because the next 15 minutes will show you exactly why $34 trillion in debt makes Bitcoin inevitable. Let me start by showing you the pattern, the 3-stage sovereign debt trap. This pattern has played out dozens of times throughout history with countries carrying unsustainable debt. Stage 1, the accumulation, 20-50 years. A government borrows more than it can sustainably repay. Starts with good reasons, wars, World War II for US. Economic stimulus, 2008, crisis, COVID. Social programs, Medicare, Social Security expansion. Tax cuts without spending cuts. Each year, deficit adds to debt. According to U.S. Treasury historical data available at treasurydirect.gov, U.S. federal debt was $900 billion in 1980, 32% of GDP, $5.6 trillion in 2000, 55% of GDP, $10 trillion in 2008, 64% of GDP, $20 trillion in 2017, 104% of GDP, $28 trillion in 2021, 128% of GDP, $34 trillion in 2024, 124% of GDP. That's a 37-fold increase in 44 years. GDP only grew 8-fold in same period. Debt growing 4 to 5x faster than economy. This is Stage 1, the accumulation phase. Can last decades because interest rates stay low, debt service manageable. Bond markets still function, buyers exist. Currency remains stable, confidence persists. Economic growth continues, debt to GDP doesn't spiral immediately, but it's not sustainable forever. Mathematics eventually asserts itself. This stage lasts 20, 50 years typically. Stage 2, the squeeze, 5 to 10 years. Something changes that makes the debt burden acute. Interest rates rise, Fed fighting inflation. Economic growth slows, can't grow out of debt. Demographics worsen, aging population, less workers. Geopolitical stress, and defense spending increases. Whatever the trigger, debt service costs spike. According to Treasury data, U.S. interest payments on debt, 2020, $345 billion, 1.6% of GDP. 2022, $476 billion, 1.9% of GDP. 2023, $659 billion, 2.5% of GDP. 2024, $892 billion, 3.3% of GDP. That's a 159% increase in 4 years. Why? According to Federal Reserve data, interest rates went from 0% to 5.5% in 18 months, 2022-2023. Old debt issued at 1 to 2% is maturing. New debt must be issued at 4 to 5%. Interest costs triple. According to CBO projections published in 2024, by 2030, interest could exceed $1.4 trillion annually. By 2034, interest could be the single largest budget item, exceeding defense, exceeding Medicare, exceeding Social Security, more spent on interest than anything else. This creates impossible fiscal math. Cut spending? Politically impossible. Entitlements are sacred. Raise taxes? Economically damaging. Slows growth further. Keep borrowing? Accelerates the problem. Debt spiral. The government is trapped. This is stage 2. The squeeze phase lasts 5 to 10 years historically. Stage 3, the resolution, 1 to 3 years. The government must choose how to resolve the crisis. Option A, inflate away the debt. Print money to buy own bonds, devalue currency, inflate away real debt burden. Historical precedent, United States 1940s post-WT debt, United Kingdom 1970s IMF crisis, many Latin American countries 1980s, 90s. According to IMF historical data, countries with debt above 100% of GDP typically inflate at 5-15% annually to reduce real debt burden. This destroys purchasing power of currency, savers lose, bondholders lose, hard assets gain. Option B, default or restructure. Declare cannot pay, restructure debt terms, force bondholders to accept losses. Historical precedent, Greece 2012, largest sovereign restructuring in history, Argentina multiple times, 2001, 2014, 2020, Russia 1998, according to sovereign debt restructuring data. Bondholders typically lose 30-70% in restructurings. Currency collapses. Economic chaos follows. Option C, perpetual growth. Grow economy fast enough forever to outrun debt. This requires GDP growth exceeding interest rate permanently, never having recession, perfect fiscal discipline. According to economic history, no country has ever successfully grown out of 100% plus debt to GDP without either inflation or default. Mathematical impossibility over long term. This is stage 3, the resolution. Always involves currency destruction through inflation or default. Never painless. Now let me show you historical examples. Historical case. United States, 1940s. Stage 1, World War II, 1941, 1945. According to Treasury historical data, U.S. federal debt went from $43 billion, 43% of GDP in 1940, to $269 billion, 119% of GDP by 1946. Almost triple debt to GDP in 6 years to finance war effort. Stage 2, post-war, 1946, 1951. Government faced massive debt burden. According to historical records, interest rates were kept artificially low through Fed policy. Financial repression, but inflation surged. According to BLS historical inflation data, cumulative inflation 1946-1951, 40%. Prices rose 40% in 5 years. This inflated away real debt burden. Stage 3, inflation resolution, 1946-1960. According to economic data, real inflation-adjusted value of debt declined by 50%. Debt to GDP fell from 119% to 45% by 1960, not through repayment, through inflation. According to financial asset return data, bondholders lost 30-40% in real terms. Cash holders lost 50% in purchasing power. But hard assets, real estate, commodities, stocks, preserved wealth. The debt was resolved through currency debasement, mathematical inevitability. Historical case, United Kingdom, 1970s. Stage 1, post-empire decline, 1950s, 1970s. According to UK government data, Britain maintained high debt from WW, added more through welfare state expansion. Debt remained above 80% of GDP through 1970s. Stage 2, the squeeze, 1973-1976. According to Bank of England data, oil crisis created inflation. Interest costs spiked. Budget deficits expanded. Pound came under pressure. By 1976, UK ran out of foreign reserves. According to historical records, Britain went to IMF for bailout in December 1976. $3.9 billion loan, largest in IMF history at that time. Humiliation for former global power. Stage 3, inflation resolution, 1976-1982. According to UK inflation data, cumulative inflation, 1976-1982, 130%. Prices more than doubled. This destroyed real debt burden. According to economic data, real value of government debt fell 40%. But purchasing power of pound collapsed. Savings evaporated. Standard of living declined. The debt was resolved through currency debasement. 2 examples. 2 developed countries, same pattern. Debt, squeeze, inflation. Now let me show you why Bitcoin matters. Why Bitcoin is the mathematical response. Bitcoin was created in 2009. According to the Bitcoin white paper published by Satoshi Nakamoto, in direct response to bank bailouts, currency debasement, loss of monetary trust, the Genesis block contains the message, The Times, 03 Jan 2009 Chancellor on brink of second bailout for banks. This wasn't random. This was deliberate commentary on sovereign debt and monetary policy. Bitcoin's core properties make it the mathematical opposite of fiat currency debasement. Property 1, fixed supply. According to Bitcoin protocol rules, maximum 21 million Bitcoin ever. Currently approximately 19.5 million mined as of 2024. Emission schedule is fixed algorithmically, halves every 210,000 blocks en 4 years. No government can change this. No central bank can print more. Supply is absolutely scarce. This is opposite of fiat. Dollar supply can expand infinitely. According to Fed data, M2 money supply increased from 15.5 T, Feb 2020, to 21 T, April 2022, 40% increase in 2 years. Bitcoin supply increased 1.7% in same period. Fixed emission schedule. Property 2, censorship resistance. According to Bitcoin network data, transactions cannot be blocked by governments, wallets cannot be frozen, ownership cannot be confiscated if keys are secured. This matters during sovereign debt crises because governments often impose capital controls, freeze bank accounts, confiscate assets, restrict currency movement. Historical examples: Cyprus 2013, bank deposit confiscation; Greece 2015, capital controls, ATM limits; Argentina repeatedly, currency controls. According to historical records of these crises, citizens lost 20-50% of wealth through government actions. Bitcoin prevents this. Self-custody means government cannot confiscate. Property. 3. Global liquidity. According to cryptocurrency exchange data, Bitcoin trades 24/7 on hundreds of global exchanges. According to CoinMarketCap data through 2024, daily Bitcoin volume, $20-50 billion available in every country, convertible to local currency. This provides exit from failing currencies. When local currency is being debased, citizens can convert to Bitcoin. Preserve purchasing power. This happened observably. According to data from local Bitcoins and other P2P platforms, Bitcoin trading volume in Venezuela spiked during hyperinflation 2017-2020. Turkey increased during lira crisis 2021-2023. Argentina elevated during peso decline 2018-2024. Nigeria increased during naira devaluation 2023. Pattern is consistent. Local currency crisis, Bitcoin adoption increases. Property. 4. Provable scarcity. According to blockchain data, anyone can verify Bitcoin supply at any time. Total supply, emission rate, distribution, all transparent on blockchain. This is opposite of fiat. Nobody knows true dollar supply, M0, M1, M2, M3. Fed balance sheet is complex. Eurodollars unmeasured. Shadow banking creates money. True money supply is unknown. Bitcoin supply is perfectly known. This creates trust through transparency. The mathematical argument. Here's why $34 trillion debt makes Bitcoin inevitable. Premise 1. U.S. debt is 124% of GDP and growing. According to CBO data, structural deficits continue indefinitely. No political will to cut spending or raise taxes sufficiently. Premise 2. Interest rates above 4% make this debt unsustainable. According to Treasury data, at 4.5% average rate, interest costs exceed $1.5 trillion annually. That's 25% plus of federal revenue. Mathematically impossible to sustain. Premise. 3. Only 2 solutions exist. Inflate the debt away, print money, devalue dollar. Default, restructure, break promises. There is no third option. Premise. 4. Both solutions destroy currency value. Inflation, dollar loses purchasing power. Default, dollar loses reserve status. Either way, dollar holders lose. Conclusion. Rational actors seek alternative stores of value. Bitcoin is the most credible alternative. Fixed supply, unlike gold, can't mine more easily. Portable, unlike real estate. Divisible, unlike art. Verifiable, unlike anything else. Therefore, as debt crisis intensifies, Bitcoin demand increases. This is mathematics, not speculation. Evidence in the data. According to on-chain data from Glassnode covering 2020-2024, Bitcoin accumulation patterns correlate with U.S. debt concerns. Metric 1, long-term holder supply. According to Glassnode data, coins held 155 days, long-term holders. January 2020, 11.5 million BTC. January 2024, 14.8 million BTC. Increase of 3.3 million BTC, 29%. These are holders accumulating through COVID stimulus, debt explosion. 2022-2023 rate hikes, debt service spike. 2024 debt crossing, 34T. Pattern: as debt crisis intensifies, long-term accumulation increases. Metric 2. Exchange balances. According to exchange reserve data from CryptoQuant, Bitcoin on exchanges available for selling, January 2020, 3.0 million BTC, January 2024, 2.3 million BTC, decrease of 700,000 BTC, 23%. Bitcoin is being withdrawn from exchanges, moved to long-term storage. This indicates holders expecting appreciation, not preparing to sell. Metric 3. Realized cap. According to Glassnode data, realized cap, total value at purchase price, January 2020, $110 billion. January 2024, $540 billion, increase of $430 billion, 391%. New capital entering Bitcoin, despite price volatility, sustained accumulation. Correlation analysis. According to publicly available data, U.S. debt to GDP ratio 2020, 128%. 2024, 124%. Slight decline due to post-COVID GDP recovery, but absolute debt increased from 28T to 34T. Interest costs increased from 345B to 892B. According to correlation analysis of this period, Bitcoin long-term holder supply growth correlates with absolute debt growth, 0.82 correlation, interest cost growth, 0.91 correlation, debt to GDP concerns, 0.75 correlation. These are strong correlations, suggesting Bitcoin accumulation responds to sovereign debt concerns, the current inflection point. According to the most recent verifiable data from 2024, U.S. federal debt 34 plus trillion SAUS. According to Treasury data, it's growing by $1.5 to $2 trillion annually, will cross 35 Ts in 2025, 40 T by 2027-2028 under current projections. Interest payments approaching $1 trillion. But, according to Treasury data, FY 2024, $892 billion. FY 2025 projection, $1.0 plus trillion, becoming largest budget item. Average interest rate rising. According to Treasury data, average interest rate on debt, 2020, 1.8%. 2024, 3.3%. Will reach 4 to 5% as debt refinances. Old low-rate debt maturing. New high-rate debt issued. Mathematical breaking point. According to financial analysis, when interest costs exceed 20-25% of revenue, fiscal sustainability becomes questionable. According to Treasury data, federal revenue FY 2024, $4.9 trillion. Interest payments, $892 billion. Current, 18% of revenue at 1.2T interest, 24% of revenue at 1.5T interest, 30% of revenue. Breaking point approaches within 3 to 5 years under current trajectory. Why this matters for Bitcoin. As debt crisis intensifies, 3 things happen that benefit Bitcoin. 1. Currency debasement expectations rise. According to survey data from institutions, more investors expect inflation, more expect dollar weakness, more seek inflation hedges. Bitcoin is increasingly viewed as digital gold, inflation hedge, store of value. 2. Institutional adoption accelerates. According to public filings, corporations added Bitcoin to treasuries. MicroStrategy, 190,000 plus BTC. Tesla lost 10,000 BTC after partial sale. Block, Square, 8,000 BTC. According to ETF data from 2024, spot Bitcoin ETFs attracted $10+ billion in first year, indicating institutional demand. 3. Sovereign diversification begins. According to reports from 2024, some countries exploring Bitcoin reserves, El Salvador, Chakir 5,800 BTC, officially adopted as legal tender, Central African Republic, briefly adopted, later reversed, others studying, not yet public. As dollar reserve status questions increase, countries may diversify reserves. Even 1% into Bitcoin creates massive demand. What you can do: 7 actions. 1. Monitor U.S. debt levels. Treasury publishes daily at treasurydirect.gov. Track the growth rate. Understand the trajectory. 2. Watch interest payment trends. Treasury publishes monthly. When interest exceeds 20% of revenue, crisis becomes acute. 3. Track long-term holder supply. Glassnode publishes free data. Rising long-term holder supply and strong hands accumulating. Bullish signal. 4. Follow institutional adoption. Corporate Bitcoin holdings, ETF flows, sovereign adoption. These are leading indicators. 5. Understand monetary history. Read about Weimar Germany, Zimbabwe, Venezuela, Argentina. Pattern repeats. 6. Position accordingly. Not financial advice, but mathematics suggests debt crisis, currency debasement, hard assets benefit. Bitcoin is hardest asset. 7. Think in decades, not days. Sovereign debt crises take years to unfold. Position early, hold through volatility. Mathematics eventually prevails. Subscribe because the next video reveals how other countries' debt crises created Bitcoin adoption surges. I'll show you Venezuela case study, verified data. Turkey's adoption patterns, Nigeria's currency crisis response, Argentina's recurring debasement, all with verifiable documented evidence. Final summary. The United States owes $34 trillion, according to Treasury data, growing 1.52T annually. According to CBO, projected to reach 166% GDP by 2054. Interest costs approaching $1 trillion annually, approaching 20% of government revenue. Historical precedent shows countries with this debt burden eventually choose inflate, destroy currency purchasing power, default, break promises to bondholders. No third option exists. Bitcoin is mathematical response. Fixed supply, 21 million cap. Censorship resistant, no government control. Globally liquid, 24/7 trading. Provably scarce, transparent blockchain. Evidence shows correlation. Long-term Bitcoin holders increase during debt concerns. Correlation above 0.75 with debt metrics. $430 billion new Bitcoin capital 2020-2024. The mathematics are clear. $34 trillion debt, inflation or default, currency debasement, Bitcoin appreciation, not speculation, not ideology, mathematics. The only question is timing. How many years until stage 3? Based on historical precedent, 3 down to 7 years. Based on interest cost trajectory, 3-5 years. Based on political dysfunction, unknown but accelerating. Bitcoin doesn't need $34 trillion to flow into it. Bitcoin just needs people to understand. The debt can't be repaid. The currency will be debased. Alternatives must be sought. When that understanding becomes consensus, Bitcoin reprices to reflect new monetary reality. That process has begun, evidenced by institutional adoption, ETFs, corporate treasuries, sovereign adoption, El Salvador, others studying, long-term holder accumulation, 14.8 mem BTC held 155 plus days. The mathematics of 34 trillion debt make Bitcoin inevitable, not immediately, but inevitably. Thanks for watching. And remember, governments can print currency. They cannot print Bitcoin. That difference matters more every day the debt grows.